Hi everyone, and welcome back to the channel. I'm Lynn. Today, we're talking about a name everyone knows, Amazon. Every time we shop, stream Prime Video, or use a cloud service, we're fueling this massive empire. As of October 9th, 2025, Amazon's stock is flying high, over $225 a share. And market sentiment couldn't be more bullish. But as investors, when everything looks perfect, that's when we should be the most cautious. After digging into the numbers, our team believes Amazon's fair value was closer to $181.50 per share. That means the market could be overvaluing the stock by almost 20%. So how did we get here? Let's break it down. You can't value Amazon as a single business. It's more like a holding company, a mix of very different parts. High-margin tech like AWS, and low-margin, capital-heavy retail logistics. Valuing both the same way is like judging a marathon runner by their 100-meter sprint. That's why we use a sum-of-the-parts approach, valuing each segment separately to see where the real value lies. Let's start with the money machines. First, AWS. It's the king of cloud computing. Stable, sticky, and extremely profitable. We value AWS at around $534 billion. Next, advertising and marketplace. This is Amazon's hidden giant. Third-party seller fees, plus ad revenue from brands paying for visibility. We estimate this segment's worth at about $1.17 trillion, making it Amazon's single biggest value driver. Together, these two segments make up roughly 85% of Amazon's total enterprise value. But even these cash cows face real risks. AWS battles Microsoft and Google for cloud dominance. Advertising is under constant antitrust scrutiny. The market seems to be ignoring these headwinds. Now let's talk about the Amazon we all know, the retail business. The boxes, Prime Day, next day delivery, all of that. Yes, it generates huge revenue, but profit margins are razor thin. It's capital intensive and requires constant reinvestment in logistics and warehouses. From a valuation standpoint, retail contributes surprisingly little. It's more of a strategic engine, driving user traffic, fueling ads, and locking customers into the Prime ecosystem. It's about scale, not profit. Then there's the innovation bucket. Prime Video, Echo, healthcare, and new ventures. We treat these as Amazon's internal venture capital portfolio. The potential is exciting, especially healthcare integration, but they're still cash-intensive and far from profitability. Yet, the market already prices them as if they're guaranteed winners. That's optimistic, maybe too optimistic. After adding everything up, AWS, ads, retail, new ventures, and subtracting let debt, our sum-of-the-parts model gives a fair value of $181.50 per share. That's solid, but at $225, the market's already pricing in a best-case scenario. There's little margin for error, whether it's slower AWS growth, new regulations, or a macro slowdown. Amazon is a fantastic company, massive moat, dominant ecosystem, visionary management. But even great businesses can be overpriced. At this level, the risk-reward skews to the downside. Here's what we do. New investors, wait for a pullback before buying. Current shareholders, no need to panic. The long-term story is strong. But if your position is large, consider trimming a bit to lock in gains. We're initiating coverage with a neutral rating. Love the company, cautious on the stock. The art of investing is finding that balance between a great business and a great price. So what do you think? Is Amazon overvalued, or are we just underestimating its future potential? Let me know in the comments. If you found this breakdown helpful, don't forget to like, subscribe, and turn on notifications so you don't miss our next deep dive. I'm Lynn. Thanks for watching, and I'll see you next time.